Welcome back to The Explainer. Today, we're unpacking a truly wild week in the markets. We're looking at a bizarrely paradoxical jobs report, a massive tech titan unexpectedly pivoting into the cloud space, and traditional Wall Street aggressively migrating onto the blockchain. These aren't just, isolated blips on the radar. They're actually all completely interconnected in this massive market regime shift. Let's get right into it.
Okay, so let's dive into this massive contradiction right off the bat. How on earth does the absolute worst jobs print we've seen since February actually send the Dow Jones surging nearly 600 points to close at an all-time record high of 52,900? It feels totally counterintuitive, right? Like the math just isn't mathing? Well, let's untangle.
Here's how we're going to break this down. First, we'll look at why bad news is actually good news in the macroeconomy right now. Then we'll cover the AI cloud wars igniting, Wall Street moving on-chain, a spotlight on this massive corporate deal with Sharon AI, and finally, we'll map out your roadmap for the week ahead.
All right, Section 1, bad news is good news. Let's look at this macroeconomy shift.
So the sheer size of this miss is just staggering. The U.S. economy was supposed to add 115,000 jobs in June, but instead, we got a mere 57,000. That is literally less than half the consensus estimate. Oh, and to make it even spicier, previous months were revised sharply lower, wiping out another 74,000 reported positions. Now on paper, you'd think, wow, absolute disaster. But for the market, this was the ultimate normalization signal. Basically, the market is pricing in a soft landing. The economy is slowing down just enough to kill inflation, but without triggering some brutal recession. The labor market is finally cooling off to a sustainable pace, which means the Federal Reserve actually has the data-driven permission it needs to just hit pause on imminent rate hikes.
And you can see this historic divergence brilliantly playing out in the market's completely split personality. The Dow Jones hit an all-time record, fully driven by this defensive rotation. We're talking companies with real earnings and dividends. Your Apples, your Walmarts, your Visas, they all surged. But if you look over at the NASDAQ, it actually took a hit. AI infrastructure and semiconductor names faced a pretty steep sell-off. So what's the takeaway for us here? Well, the broader market is rotating its money right out of risky, expensive tech and pouring it straight into safe, dividend-paying stalwarts. Investors want slower growth without those rate hikes, and they are putting their capital exactly where that narrative thrives.
Adding some serious fuel to this macro shift was Fed Chair Kevin Warsh. He was speaking at a central banking forum in Portugal and delivered this incredibly blunt three-word warning: "I will disappoint you." He was speaking directly to anyone expecting him to just tolerate inflation running above 2%. But honestly, the real bombshell here, he flat out refused to give any forward guidance. Warsh effectively announced that the whole era of central banks telegraphing every single move is dead. When they shut the door in July, they're debating based purely on the data. And with that 57,000 jobs print we just talked about, well, the data is heavily favoring a pause.
Now, here is an absolutely crucial point. When you take that jobs miss and combine it with WTI crude oil collapsing down to $68 a barrel, you get the ultimate disinflationary backdrop. Oil has plummeted from its $112 war peak. That $44 drop is a massive tailwind for the U.S. economy. And honestly, it hasn't even fully shown up in the inflation data yet. The significantly lower energy cost paired with the cooling labor market powerfully reinforces that exact soft landing narrative that the doll is currently pricing in.
Moving on to Section 2, the AI cloud wars ignite. Let's talk about this tech sector shakeup.
So if the macro picture was so rosy, why on earth did the NASDAQ stumble? Well, the answer lies with a $1.5 trillion giant. Reports broke out that Meta is planning to monetize its massive excess GPU capacity. Basically, they're entering the cloud computing market. They want to start renting out compute time to third-party AI companies. To put it simply, Meta is essentially becoming a landlord for AI brainpower. They are flexing their muscle and stepping directly into the cloud computing ring. And look at the market shockwave this created. Meta stocks surged 9% on the news, but those pure-play AI infrastructure companies, the smaller neo-clouds whose entire business model is just renting out chips, they took an absolute beating. CoreWeave crashed 14%. Nibius Group dropped 17%. The translation here is simple, but man, is it violent. Investors are suddenly questioning if these smaller neo-cloud valuations are actually sustainable, especially now that a literal giant with unlimited capital and 4 billion users is competing for the exact same enterprise customers. It fully validates that renting GPUs is incredibly profitable, but it completely disrupts the whole competitive landscape.
All right, Section 3, Wall Street moves on-chain. The financial rails are officially migrating.
Listen, we are way past the days of just crypto experimentation.
The traditional financial system is officially packing up and migrating. Robinhood just launched its own Ethereum-compatible Layer 2 chain built on Arbitrum. Think of it like a high-speed, low-cost express lane built right on top of Ethereum, specifically for tokenized assets and AI trading. Meanwhile, a massive consortium, we're talking Visa, MasterCard, Google, and BlackRock, announced OpenUSD, which is this incredible enterprise-grade stablecoin. And get this, they chose to launch it on Solana. Traditional Wall Street is literally out here building institutional-grade infrastructure on public blockchains. They aren't just trading coins anymore. They are building the actual rails.
And you better believe the market paid attention. For anyone keeping an eye on the crypto space, this is the ultimate signal. This isn't just retail hype, this is hardcore institutional validation. When a consortium of the world's absolute most powerful financial institutions picks your chain to launch its unified stablecoin, that is a multi-trillion-dollar endorsement of your network's transaction throughput. As a direct result, Solana surged 16 to 19% for the week, pushing right past $81. It completely bridges that massive gap between traditional finance and decentralized tech.
Section 4. Spotlight on the Sharon AI deal. Let's look at the explosive AI growth over in the Asia-Pacific.
To really grasp this explosive corporate case study, we first need to define a term: sovereign AI infrastructure. This means providing advanced GPU cloud computing that explicitly, strictly complies with local data residency and sovereignty laws. Think about it. Australian government agencies and defense organizations literally cannot host their sensitive AI workloads on US-based servers. They absolutely need domestic alternatives. And that's exactly where Sharon AI Holdings comes in. They are totally cornering this niche in the Asia-Pacific market, offering the kind of local data compliance that the massive US hyperscalers simply cannot provide.
And the sheer, validated scale of this operation is just staggering. Take a look at that 72-megawatt figure. This week, Sharon AI announced a massive 6-year strategic collaboration with NVIDIA to build 72 megawatts of new AI data center capacity in Australia. We are talking about scaling up to 40,000 of NVIDIA's absolute most advanced Grace Blackwell GPUs. That represents roughly $1.6 billion in hardware value being deployed locally. NVIDIA is even stepping in to provide financing assistance in exchange for preferred supplier status. Just huge.
So what does this actually mean for the business itself? Well, Sharon AI went public on the NASDAQ back in February at $30 a share. But following this NVIDIA deal and amassing an incredible $2.2 billion in signed contracts, the stock has been trading between $79 and $85. That is a 261% return in just 90 days. Crazy, right? And backing this all up, they've raised $1.6 billion in private placement financing. The main takeaway here is crystal clear. The AI infrastructure boom is playing out globally, well beyond Silicon Valley, and companies dominating this regional, sovereign AI space are seeing absolutely explosive financial validation.
Finally, Section 5, the week ahead. Let's break down the key upcoming data you need to watch.
We've got a crucial chronological roadmap ahead of us. Monday kicks off with the ISM Services PMI, which is going to give us a vital read on 70% of the entire U.S. economy. Then by Wednesday, we get to sort of listen in on the internal chatter track with the FOMC minutes. That's going to reveal just how intense the internal debate over rate hikes really is under Chair Warsh. And then by Thursday and Friday, big bank earnings from heavy hitters like JP Morgan and Wells Fargo will prove whether or not the Dow's defensive rally is actually justified by underlying credit health. But make no mistake, the absolute most important event on the calendar is Friday morning at 8:30 a.m. Eastern, the June CPI print. It's quite literally going to be the Super Bowl of inflation data. Why? Because this is going to be the very first reading that fully captures that massive drop in oil prices we talked about earlier, that dramatic fall from over $90 all the way down to $68. The math strongly suggests the headline inflation number should fall pretty dramatically. Which brings me to the final critical thought I want to leave you with today. If that headline CPI does fall dramatically because of cheaper energy, will core inflation actually follow suit? Because look, if core inflation drops alongside the headline, the rate hike thesis is effectively dead for the year. That completely cements the soft landing the market has been dreaming about. But if core inflation stays stubbornly elevated despite the cheap oil, will the Fed be forced to shatter those market dreams and stay hawkish? Friday holds the answer. Thank you so much for joining this explainer. Stay curious, and as always, keep your eyes on the data.